Let us now take up for discussion fiscal policy. So let's understand what's fiscal policy. Fiscal policy refers to the government's use of spending and tax policies to influence various aspects of the economy. So within the ambit of fiscal policy would fall the government's policy of spending, which is the expenditure of the government, as well as the tax policies. So by way of tax policies, the government would be raising revenue. So we essentially would be focusing on the policies that the government would be pursuing to spend as well as to raise tax revenues, with the objective being to influence the level of aggregate demand and therefore the overall economic activity. Alright, so this is one of the objectives, and in fact this is the one that we are going to largely focus upon. How can fiscal policy be used as a tool by the government to influence aggregate demand, to stimulate economic activity in case if there's a slowdown, or to cool down economy if there is a bit of overheating of the economy. The distribution, or may I say the redistribution of wealth, and the allocation of resources between different subsectors and economic agents. So we shall to begin with focus upon how would fiscal policy be used to influence the level of aggregate demand. So what are the roles and objectives of fiscal policy? The main aim of fiscal policy is to regulate the economy's real GDP by influencing aggregate demand. So just reiterating the same point. Expansionary fiscal policy involves one or more of the following. So guys, do understand, expansionary fiscal policy will be pursued in case if there is a slowdown in the growth of the economy. So in case if there is a decline in aggregate demand or a slowdown in aggregate demand, that's when the government would be pursuing an expansionary fiscal policy, which could involve one or more of the following. Reducing personal income taxes to increase disposable income. Alright, so reduce taxes so that there is more income in the hands of individuals, encouraging individuals to go out and spend. Reducing indirect taxes to raise real income. Reducing corporate taxes to boost profits so that these profits could be used by the corporate to either distribute amongst the shareholders or retain part of it and invest aggressively into capital formation, into investments. Reducing taxes on savings to raise disposable income. Increasing expenditure on social goods and infrastructure, which increases the personal income. So not only reduce taxes but also increase expenditure. Alright, so the government on its part would increase expenditure on social goods and infrastructure, which in turn will of course go on to increase personal income, because invariably this expenditure would go down in the form of income to the individuals and institutions involved in the creation of these goods and infrastructure. Alright, so we realize that expansionary fiscal policy could result in the decline in the tax revenues of the government because of the reduction in tax rates, as well as it could result in an increase in expenditure, thereby widening the deficit that the government might have or shrinking the surplus that the government might have as far as its budget is concerned. Now, Canadians believe that fiscal policy can have a powerful impact on aggregate demand, output and employment. So in fact, Keynes was somebody who strongly advocated government's intervention as and when there was a slowdown in the economy, and he strongly believed that by way of the fiscal policy, by way of the tools that are available within the fiscal policy, the government would be in a position to stimulate demand and hence bring back the economy on its normal course. Now, monetarists believe that fiscal changes only have a temporary impact on the economy, and that monetary policy is more effective in controlling inflation. Alright, so monetarists, keep in mind guys, they do believe that neither fiscal nor monetary policy tools could be effective in influencing aggregate demand. At best, monetary policy tools can be used to control inflation. Now, that's what the monetarists believe. So, fiscal policy is an important tool for economic stabilization through its impact on output. In a recession, the governments can increase spending or reduce taxes, and that's what would be termed as expansionary fiscal policy, to try to raise employment and output. In an expansion, so that is when clearly the economy is getting overheated, the government can reduce spending and increase taxes, and that's what would be termed as contractionary fiscal policy, to try and control inflation and to try and cool down the overall economy, so that the aggregate demand kind of holds back, comes down, and hence price as well comes down. So inflation as well as overheating of the economy gets controlled. So the budget surplus or deficit equals the difference between the government's revenue and expenditure over a period of time, and we realize that there would be an increase in budget surplus when the government is pursuing contractionary policy, all right? Or in case if there is a budget deficit, it as well could come down. So either the budget surplus would go up. So guys, it's pretty simple. Now we understand budget surplus as the revenue of the government, essentially the tax revenue, minus the expenditure of the government. Okay. Now, in case if the government is following a contractionary policy, and that is when the government would believe that inflation is riding high, the economy is overheated, so that warrants a contractionary fiscal policy. Basically, what it would mean is bringing down expenditure, increasing taxes. Now that would increase the revenues, could bring down expenditure, and hence net it could increase the budget surplus. All right. Now, in case if the economy is slowing down and the government wants to increase and stimulate the economy and increase aggregate demand, it would be pursuing an expansionary policy, which basically would mean that revenue, the tax rates, or let's say the taxes would be reduced so that the revenue comes down, and the government might become a little more aggressive in terms of spending, so that finally there's some income that goes down to the public, and hence one would see that this could result in budget deficit going up. And in case if there's a surplus in the first place, it would come down. So that's where the budget deficit goes up. Budget deficit is basically when your revenue is less than your expenditure. All right. So automatic stabilizers, now essentially two categories that we are going to discuss. One is the role of automatic stabilizers, and two, the discretionary policy followed by the government. Now, what are automatic stabilizers? Now, they work in the absence of explicit action by the government to bring the economy towards full employment. All right. So these are essentially policies which work on autopilot basis, and they would immediately get triggered by the situation that prevails in the economy. So, for instance, induced taxes. Now, revenue from income taxes would go up during expansion in the economy. So, when the economy is growing and growing furiously and strongly, that's when the tax as well would go up, because if rates of taxes are specified, if the income goes up, the overall tax revenue would go up. So automatically you would realize that the government would be collecting greater taxes from the public, and this would tend to have some kind of a restraining effect on the economy. So this is some kind of an automatic stabilizer. It's not that the government would go out and increase tax rates. It's just that the tax rate, because it's specified in percentage terms, in absolute terms could still go up. Needs tested spending. Now, these are government programs that pay benefits to qualified individuals and businesses. For example, unemployment benefits. So clearly, when the economy is in recession, there will be many more people who would be applying for unemployment benefits, And so clearly, the government programs would be paying greater benefit to the individuals and businesses. So automatically, the expenditure of the government goes up. Empirical evidence suggests that automatic stabilizers play a significant role in mitigating deviations from potential output. They reduce the severity of both expansions and recessions. So, as an expansion, one would realize that taxes would go up, needs tested spending or needs based spending would come down, and hence net you would see that government would be collecting more money from the public, and hence it could cool down the economy a bit. And in the case of recession, your spending goes up, the tax revenues go down, and clearly the government is playing its role in terms of trying to stimulate the economy. And that's what would be termed as automatic stabilizers, and that could come in the form of increased tax revenue, induced taxes, or in the form of doling out more social benefits. Discretionary fiscal actions, on the other hand, are discretionary actions which are taken, which are enacted by the government and involves changing the tax rates or the level of government spending in response to the situation which is prevailing in the economy. Now, basically, these actions are up to the government's discretion as opposed to automatic stabilizers which act on their own, as I said, on an autopilot basis to bring the economy towards full employment. Now, why would one be concerned about national debt relative to GDP? Because we all understand that the government can resort to expansionary fiscal policy while trying to stimulate demand in the economy. But in the pursuit of doing so, the government can run into budget deficits, and these budget deficits need to be financed. When the expenditure is greater than the revenues, well, clearly that needs to be financed, and hence the government could be raising debts. Now, should we be concerned about the debts, the public debts, relative to GDP when compared as a proportion of GDP? The answer is possibly yes, because high debt levels may lead to high tax rates in the future, and high expected future tax rates may sometimes serve as a disincentive for labor and entrepreneurial activity, because simply these guys would think that going forward, even if they earn a great amount of their earnings would be taken away by the government in the form of taxes, and hence if markets lose confidence in the government, the central bank may have to print money to finance the deficit. All right, so clearly when the government would not be able to raise money at favorable terms, it would be the central bank which would be monetizing the debt, and when it does so, that could always increase liquidity in the system, and that in turn could trigger inflation. And again, government spending can sometimes crowd out private investment as well, because government spending and hence government's raising of debts could sometimes increase interest rates, and in turn could make financing and investment less attractive for private stakeholders, for private investors. Now, the reasons not to be concerned about national debt relative to GDP: one, as long as this debt is denominated in local currency and it is owed to the country's own citizens. Some of the borrowed funds may have been used for capital investment projects, which in turn would help raise the economy's productive capacity and tax revenues going forward. So there's something good, positive to look forward to. The private sector may adjust to offset fiscal deficits by increasing savings in anticipation of future tax increases to finance the debt. All right. Now, this in turn could actually cool down the economy as well. So, to whatever extent the government tries to stimulate the economy, well, there could be an offsetting impact in terms of the private sector, the individuals saving more rather, because they do anticipate tax rates going up. in the future. And this is exactly what we talk about in the context of Ricardian equivalence. If there is widespread unemployment in the economy, fiscal deficits will not be diverting any resources away from productive uses, so total output will increase. All right, so if there is some spare capacity which is there in the economy, well, it could possibly result in utilization of those idle resources. Large fiscal deficits require tax changes, and so sometimes deficits by themselves could force in corrective actions and hence would correct the distortions which could have been created by the current tax structure. So coming over to government spending could take the following forms. We realize that government spending could be an important tool in terms of influencing the aggregate demand. So one of the ways in which the government spends is by way of transfer payments, which are welfare payments that include unemployment benefits, job search allowances, and income support for poor families. Now, they provide a way for the government to change the overall distribution of income in the economy. So it kind of gives the government a way to redistribute wealth and income in the economy. And mind it, guys, these payments, transfer payments, are not part of GDP. While they do increase personal disposable income and hence could play a role in stimulating aggregate demand, transfer payments per se are not part of GDP. The current government spending refers to spending on goods and services that are provided on a recurring, regular basis, health, education, and defense. So apart from transfer payment, this is another category of government spending, and this type of spending has a significant impact on the quality of human capital and on labor productivity. So pretty much important. Capital expenditure, now this refers to infrastructure spending, and this type of spending contributes to the economy's capital stock and adds to its productive capacity and could possibly be critical in enhancing the national income going forward. So how do we justify government spending? The government provides services such as defense that benefits all citizens equally. So the spend on defense is something which is for the good of all the citizens. Infrastructure spending, well, that's going to help the country's economic growth, enhance country's productivity. And again, government spending could help redistribute wealth in society by way of transfer payments, can be used as a tool to control inflation, unemployment, and growth, as we just saw it. Contractionary fiscal policy can help control inflation by bringing in some kind of stimuli, by bringing in some kind of social benefits, or by having aggressive spend. The government can put to use certain idle resources and hence can bring down unemployment as part of expansionary policy. And the government spending as well can be used to subsidize the development of innovative and high-risk new products. Example, alternative energy, because no other stakeholder would be willing to go forward and participate in the development of such high risk new products, and hence it's the government which needs to take the first step. Now coming over to the revenue side, the types of taxes which the government could implement and hence raise revenues. Direct taxes, now these are levied on income, wealth, and corporate profits, and include capital gains tax, labor taxes, corporate taxes, and income and property taxes. Essentially, direct taxes are a function of income, wealth, and profits of the corporate, and hence gets collected from assessees like individuals as well as corporates. Indirect taxes rather becomes a function of expenditure, okay, and hence are taxes on spending on goods and services. So VAT, which is value added tax, excise duties, which is essentially a function of the value of production, and taxes on fuel and tobacco. So these are all indirect taxes. Now, taxes can be justified in terms of raising revenues to finance government expenditure and in terms of income and wealth redistribution. So, there could be a section of population which could be exempt from tax because they happen to be categorized as economically not so well off and hence could be exempted from tax or might be extended a lower tax rate. So tax as well can be used to redistribute income and wealth uh, within the population. Now, what are the desirable properties of tax policy? Simplicity, efficiency, fairness, and sufficiency. So what do they all stand for? Simplicity. Taxpayers should find it easy to comply with tax laws and the authority should find it easy to enforce them. So easy compliance and easy enforcement. Now that's what a simple tax structure should be. Simple to enforce and simple to conform to, simple to comply with. Simple compliance, simple enforcement. Efficiency. Tax policy should minimize disincentive to work and invest. The aim of attaining efficient outcome must be balanced against the urge to promote good economic activities or the urge to discourage bad activities. Alright, so taxes in turn should be higher on demerit goods, should be lower on merit goods, and should be higher on demerit services, should be lower on merit services, so that they play a role in terms of encouraging good services, good activities, good goods, and discourages the demerit goods and services. Fairness, while the concept of fairness remains subjective, all right, it is generally believed that people in similar situations should pay similar taxes, all right, and richer people should pay more taxes. So horizontal equity and vertical equity. Revenue sufficiency. This aim may at times be in conflict with fairness and efficiency, so the government must find the right balance. So basically, the tax revenue should be sufficient to meet the government's expenditure. And as indicated, well, sometimes this could be in conflict with fairness and efficiency, because efficiency would basically warrant that the tax rate should not be too high so that it becomes a disincentive to work and invest, and fairness again should indicate that people in similar situations should pay similar taxes. But sometimes to attain sufficiency, the government might compromise on efficiency and fairness. So it could increase tax rates, and which in turn could violate the principle or properties of efficiency and fairness. So, what are the advantages of the various fiscal tools which the government has at its disposal? Indirect taxes, well, they can be adjusted very quickly. They are very effective in influencing spending behavior and in generating revenue at little cost to the government. So, indirect taxes in the form of excise, sales tax, service tax, and so on. I mean, this can be adjusted and implemented very, very quickly, and it brings about the desired result in quick time. Social objectives, reducing alcohol or cigarette consumption, for example, they can easily be met by raising indirect taxes on these so-called demerit goods. And what are the disadvantages? Direct taxes and welfare and other social transfers are difficult to change without significant notice. So you can't change ad hoc abruptly the direct tax rates. However, they begin to have an impact on behavior soon after their announcement. Alright, so it is again seen that one need not see the implementation of direct tax. So say for instance, if there is a bit of expansion in the economy is getting overheated and the government kind of gets a sense that it's time to increase tax rates. so that the so-called contractionary fiscal policy can rein the overheating of the economy, can rein in the overheating of the economy. Now, with the announcement that the direct tax rates or the income tax rates are going to go up with effect from next year, this announcement by itself can have an effect in terms of people curtailing their spend, their consumption, because they know that going forward they'll have to pay greater amount of taxes, and hence the announcement itself can bring in the desired result. Capital spending decisions are slow to plan, implement, and execute. Alright, so there are advantages and disadvantages with respect to the various fiscal tools that the government has to its disposal. In addition to their direct effects on the economy, the above mentioned fiscal policy tools also have strong expectational effects on the economy. And that's exactly what we are talking about. For example, an announcement that income taxes will be raised next year would have an impact on spending patterns almost immediately. Also note that direct government spending has a much bigger impact on aggregate spending and output than income tax cuts or transfer increases. And this is something that we would see going forward when we discuss fiscal multiplier and balanced budget multiplier, and we will realize that the impact of fiscal multiplier, which is basically something which results on account of an increase in aggregate spending of the government, the fiscal multiplier tends to be greater than the balanced budget multiplier, which essentially comes into play on account of the income tax cuts or, let's say, a rise in income tax rates. However, if transfer increases, which is basically the transfer payments, and it targets the poorest in the society whose marginal propensity to consume is highest, they can have a relatively strong impact on spending. All right. So we realize that government's spending, a rise in spending, could bring in a strong impact, especially when the overall society has a section which is not so well off, where the marginal propensity to consume is high, so that if there is some income which goes down in the hands of the poorer sections, there is a strong likelihood that they're going to spend all of it. So that would tend to bring up the value of fiscal multiplier as far as this section is concerned. So let's now move on and discuss the concept of fiscal multiplier. So let's look at the impact of a rise in government's aggregate spending. So let's say the government's aggregate spending goes up by $100, and we would now like to see the overall impact of this enhanced spending on the national income, on the GDP. Because we realize that government might be enhancing the aggregate spending in a bid to stimulate the economy. So can it do so, and to what extent would it be able to do so? Now, when the government enhances the aggregate spending by $100, this $100 kind of goes into the system in the hands of the individuals. Now, guys, do remember the individuals who would be earning this $100 are not going to spend an entire 100% of this amount. Now they need to pay taxes, and so let's say the tax rate is 25%. All right, and let's say the propensity, the marginal propensity to consume is 80%. So that means for every $100 that comes in the hands of the individuals, they're going to spend 80% of it. So $100 which has been earned by the individuals in the system, they were going to pay $25 as taxes, so they would be left with $75, and 80% of $75 is what they're going to spend. So this 80% of $75, which is basically $60, is what these individuals spend. The guys would earn $100, and when they spend $60, this $60 is again earned by somebody, right? So So this is going to create a series of value of activity that would get created. So again, this $60 in the hands of the individual, wherever it kind of falls in, will have to pay 25% tax, which is like $15. So $45, 80% of it is something like $36, if I get my maths correct. So this is how this series would kind of move on. So we realize that this is the total income that would get created in the economy, the extra income, the change in national income that one can expect on account of the stimuli which has been introduced by the government. Now this looks like a geometric series with a common ratio of 0.6. So my sum of this is going to be first term divided by 1 minus the common ratio, which is 0.6. So that basically turns out to be 100 by 0.4. Alright, so which is $250. Alright, so we realize that $100 enhancement in aggregate spending of the government would net increase the national income by $250. So you have a multiplier effect of 2.5. So we realize this 2.5 is what the multiplier is, and that's what is known as the fiscal multiplier. Alright, and how do we get this fiscal multiplier? We realize that this is 1 by 0.4. And we also realize how did we get 0.4? 0.4 is something that we arrived at effectively, if you think through, is something that we arrived at by taking 1 minus the marginal propensity to consume into 1 minus t. Alright, so pretty simple, guys. So this is how you would arrive at the multiplier. So guys, do remember this expression if you can. I think because this will help you get a sense of what shall be the multiplier. We also realize that the multiplier will be higher in value in case if the tax rate is lower. So if the tax rate is lower, well, the multiplier is going to be higher in value, and you can easily figure it out by looking at this expression. You know, lower the tax rate, lower is going to be the denominator, and hence greater is going to be the value of the multiplier. We also realize that marginal propensity to consume, the greater it is, the lower is going to be the denominator, and hence greater shall be the value of the multiplier. Okay, so that's all about fiscal multiplier that you need to know. Now let's move on and look at balanced budget multiplier. So balanced budget multiplier tends to gauge the impact of the change in the tax revenues of the government on the national income. So let's say if the government decides to, it could be increase or reduce taxes. So let's say the government in the previous case had decided to push up the expenditure by $100, and to finance that $100, let's say it decides to increase the tax revenues by $100. Okay, now this would basically mean that there would be a decline of $100 as far as a decline of $100 in the hands of the individuals. All right, now as a result of this, the individual's consumption spend would go down. To what extent, guys? Now we know that the marginal propensity to consume is what we took it as 80%. So clearly $80 is what shall be the decline in the consumption as far as the individual is concerned. So this in a sense will create a series of decline in consumptions for every subsequent individual, because the $80 decline in consumption for individual 1 would result in a decline of $80 as far as the income for the second person is concerned. So to that extent, the second person income and spend would go down to the extent of, again, a similar series. So his spend would go down to the extent of $48. Guys, do keep it in mind that $80 that the second individual earns, he'll have to pay an income tax of 25%, so which is like $20 knocked off from $80, so $60. And then he's going to spend, most likely he would have spent 80% of that $60 thanks to marginal propensity of 0.8. So we realize now this is the kind of series that would get triggered, and so overall there would be a decline in spend in the economy by these various individuals, and hence the total aggregate decline in consumption is going to be to the extent of the sum of the series, which is nothing but $80 divided by 1 minus 0.6, or may I say 80 by 0.4, which gives me $200. So I realize that the multiplier effect out here is 2.5, but when I compare it with the $100 rise in taxes, so with a $100 rise in tax, there is a decline of national income GDP to the extent of $200. So that basically would mean that the multiplier out here is 2. And this is what is known as the budget multiplier, or may I say the balanced budget multiplier. Okay, so I think this should be pretty simple to understand. The balanced budget multiplier, which in this case is going to be 2. And how did we get 2? Pretty simple. It's basically your multiplier, what we arrived at in the previous example, into 0.8, which is nothing but the marginal propensity to consume, so MPC. So multiply into MPC would tend to give you the budget, the balanced budget multiplier. So what are the issues in fiscal policy implementation? So deficits and the fiscal stance. The size of fiscal deficit cannot be used to determine whether fiscal policy is expansionary or contractionary. Alright, economists look at the structural or cyclically adjusted budget deficit as an indicator of the government's fiscal stance. The structural deficit is the deficit that would exist were the economy working at full employment. So basically kind of get a sense of what the structural deficit would be, and then kind of compare it with the kind of deficit that exists, so as to get a sense of whether the government is pursuing an expansionary or a contractionary policy. Now, government expenditure includes the cash amount of payments on debt, which inflates the actual deficit. Now, this is because the real value of outstanding debt falls with inflation, and therefore it would be more appropriate to include real interest payments in expenditure. Now, what are the difficulties in executing fiscal policy? Now, this is quite important, guys. One is the recognition lag. Now, it takes a while for the government to figure out that the economy is not functioning at potential output. Alright, so once it recognizes, the government would go ahead and recognize, once it recognizes the need for action, it would take steps, but then the implementation may be delayed in obtaining the necessary approvals, because a lot of these new policies or changed policy, they need to be legislated upon. And hence there could be some time which would be taken, and hence that would result in another lag, which is basically the action lag. And then of course, having implemented it, it would take a while for the fiscal stimulus to flow through the economy and generate the changes in spending patterns that are desired, which is essentially what impact lag is. So in terms of the lag between the occurrence of the problem and the solution and the policy actions which would be taken to attend to it, and finally when they would come into play, there could be quite a significant lag on account of the time taken to recognize it, the time taken to implement it, and the time taken to see its final impact, to see the implementation go through and to see its final impact. So what are the other macroeconomic issues which would kind of capture the difficulties in executing fiscal policy? Now, if an economy is suffering from high unemployment and high inflation, then raising aggregate demand will lead to high prices. So basically, the government would be between the devil and the deep sea. So in case if it tries to bring in stimulus to try and bring down unemployment, that could also result in inflation going out of hand. So it's not a great situation to be in. A government with a high national debt to GDP ratio will have very little elbow room to maneuver, to come up with aggressive spend policy, because it would find it difficult in raising funds to further stimulate the demand. The economy may already be operating at full employment without the government knowing it, and in that case, trying to bring in stimulus will not really have any meaningful impact, except for bringing in a rise in prices. Private investment may be crowded out as a government borrowing leads to high interest rate. That's something that we've already kind of spoken of. The fact that there may be unused resources in the economy could be down to low labor supply, not necessarily low aggregate demand. In such case, a fiscal stimulus will simply bring inflationary pressures to the economy. So let's look at the relationship between monetary and fiscal policy. So on this slide, what we're going to do is essentially look at the various combinations of fiscal policy and monetary policy and see its impact on some of the variables. So the variables that we are going to look at, one is the interest rate, the other is the output, because that's precisely what we are looking to influence by way of these policies. And then the private sector spending and the public sector spending. All right. So let's now look at the situation as it would be when the fiscal policy is easy while the monetary policy is tight. Now, we realize that the interest rates would be high under these circumstances, and pretty easy to understand so, because tight monetary policy would any which ways result in high interest rates, and they could further get firmed up, interest rates, on account of there being strong demand, which could be triggered on account of easy fiscal policy. All right. The output as well could be high thanks to the easy fiscal policy. Now, your private sector spending would be lower, because private sector spending is going to be lower because any which ways it will be crowded out by the public spending thanks to easy fiscal policy, and matters made worse on account of tight monetary policy, high interest rates, and hence investing and spending becomes pretty much difficult and unattractive for the private sector. And of course, the public sector spending is going to be high, as indicated by easy fiscal policy. Now let's move on and look at the combination of tight fiscal policy and easy monetary policy. Now, interest rates are going to be lower thanks to the easy monetary policy. The output, well, we don't know. We don't know. It could be high or it could be low, depending on what overwhelms what. Tight fiscal policy would tend to drown the output, while easy monetary policy would tend to bring in and encourage more output, possibly on account of lower rates and greater liquidity in the system, which in turn could result in there being stronger demand, at least as far as the private sector is concerned. Now, the private sector spending is going to be higher, and that's on account of low rates and easy monetary policy which is being pursued. And of course, the public sector spending is going to be lower on account of the tight fiscal policy that is being pursued. Now let's come to the third combination, easy fiscal policy and easy monetary policy. Their interest rates are going to be lower, thanks to the easy monetary policy, your output definitely is going to be higher because of the expansionary policy followed both in the physical context as well as fiscal context as well as the monetary context. The private spending is going to be higher as well as the public spending is going to be higher. Now move on and look at the tight policies which are being pursued on both fronts. The interest rates are going to be higher, the output is going to be lower, the private spending is going to be lower as well as the public spending is going to be lower. Alright, pretty easy to understand. Now let's look at the factors influencing the mix of fiscal and monetary policy and what is it that the IMF study concludes. The IMF study concluded that when not accompanied by monetary accommodation, fiscal policy, which basically, let's say, would be the increase in government spending, can have a much larger effect on GDP than similar size social transfers because transfers are not believed to be permanent. Okay, so basically, IMF's conclusion is that when the government goes out and as part of expansionary fiscal policy has the option of enhancing the government spending or enhancing the payout of social transfers, the IMF kind of believes that the increase in government spending tends to have a much more effective influence on the GDP. It tends to bring in a more long-lasting improvement in GDP than what the transfers would. Social transfers to the poorest citizens have more of an impact than non-targeted transfers, and we realize that on account of there being higher marginal propensity to consume in the case of poorest citizens. Labor tax reductions have a slightly greater impact than non-targeted transfers. And that is pretty much easy to understand on similar lines as the previous point. Now, when accompanied by monetary accommodation, fiscal multipliers are larger than what they would be without any monetary accommodation, without there being any monetary easing. And these larger multipliers results from falling real interest rates, which in turn leads to additional private sector spending. So very likely the propensity to consume goes up when interest rates go down, and which could result in higher fiscal multipliers. So there we come to the end of our discussion on fiscal policy. Thank you.